The recession has been canceled. The Fed pivot has been canceled. China's potential attack on Taiwan has been canceled. Everything's been canceled. The S&P 500 is at 4,200. We need to celebrate. Not so fast. Today we're talking about China. And we're talking about Ray Dalio's new warning on how China and the US look like they're following the classic path to war. And we're going to discuss how Nancy Pelosi's trip has raised the risk premium for the Chinese internet sector. We'll talk about his thoughts on a US-China conflict and what might happen if economic warfare takes place. We'll discuss how the Chinese internet sector, the US ADR stocks, how they're at risk of delisting if the tensions continue to rise. And finally, we'll share some final thoughts, how to prepare for this moment. Now, connect with me on social. On my email list in the description below, I love sharing periodically premium exclusive work to all of my friends so that everyone can benefit from my research. I also have short form thinking on my Twitter, and I share cool stuff on Instagram. So join me there as well. Everything's in the description below. I will discuss my thinking on the future of inflation on my email list. This video is about China and my thoughts on the US-China tension over Taiwan. So I'm going to discuss inflation and the latest data in my email. So make sure to join that in the description below. Now, I have a table of China macro risks. And of course, this is not an exhaustive list, but we can see here that captures a lot of the major risks related to investing in Chinese internet companies. And the China-Taiwan escalation, in my opinion, is the most severe. It's also a tail risk, meaning it could happen, it might not happen, but Ray Dalio has put the probability of a US-China war at up to 30% in his proprietary model, which I'll show you in just a second. I want to walk you through domestic sentiment first. And the reason I want to walk you through this is that this is a major component inside Ray Dalio's conflict gauge. And the domestic sentiment in China is becoming more nationalistic, and it's becoming more hostile against US politicians. We can see that Global Times, which is a mouthpiece for the Chinese government, the title here is saying that Chinese netizens erupt in anger over Pelosi's Taiwan visit, shows 1.4 billion people's willpower, confidence in reunification. So the language here is getting more and more serious by the day. And from the latest analysis of China's drills in the Taiwan Straits, we can see here in the red boxes, these are where the military drills are taking place. And this is dangerously close to Taiwan's internal waters. And the reason this is important is that if there's any kind of flare-up, then US and China markets will be tested once again. Now, to tell you how personal it's getting for a lot of people in mainland China, we're seeing artists and celebrities getting under the spotlight, under heat, to sync their views with the party. And not being in sync with nationalistic voices is hurting the careers of some stars. We can see that a Taiwanese artist, Jolin Tsai, she lost 270,000 followers after not sharing "There is only one China" post following Pelosi's visit. So Ray Dalio captures all this sentiment data into his model, which I'll show you in a minute. He said on LinkedIn recently that the geopolitical landscape has become far more dangerous and that there will be enormous consequences if there is a US-China escalation. And this is the conflict gauge that I've been referring to over the past several minutes. And this is Ray Dalio's proprietary model that helps predict the likelihood of a war. And we can see that this conflict gauge is at the upper end of the range. It's near its all-time highs, actually. And the way the conflict gauge is constructed is from the following components: changes in military spending, personnel and deployment, sentiment of each country's people about the other country. So you can see the reason I wanted to show you this here is so that you can understand how that factors in to Ray Dalio's model. And also media attention given to the conflict. That's why I wanted to show you how China's media outlets is portraying their citizens' views towards Nancy Pelosi and US politicians. This is certainly going to raise the risk premium attached for all US adhere companies like Alibaba, Tencent, Baidu, the K-Web ETF. Now, China's PLA is conducting daily military drills on the Taiwan Strait. This is an example of deploying personnel and deployment from Ray Dalio's conflict gauge. And on top of this, the military spending of China over the past 2 decades have risen substantially as a percentage relative to the US. And this has caused the US on US news media outlets, Bloomberg, Wall Street Journal, to produce scenario analysis now of air, land, and water attacks being conducted in the Taiwan Straits. This analysis is being conducted from the Pentagon and the US Army. And scenarios are also being created to assess war outcomes if Japan or other neighboring countries like North Korea or South Korea were to get involved. So the economic impact of all of this is a stock market investor's worst nightmare. This trumps any high inflation issue. This is one of the biggest tail risks in the market. Now, China constitutes up to 19% of all manufactured US goods imports. And in the event of a large-scale escalation, Ray Dalio says supply chains would collapse, economic activity would dive, and inflation would soar. And according to US trade data, China was the US's largest supplier of goods imports in 2020 and also likely in 2021. And this is important because if there is a large-scale escalation, the estimated impact on the US and China economy would be substantial. Some estimated implications include large disruptions with imports and exports from China. This would create sky-high inflation. This would make supply chains severely disrupted. For China, there would be serious economic sanctions from the West, similar to what Russia is seeing today. There would be a decoupling from many international systems. In that kind of situation, I see the view of delisting of US ADRs to be nearly 100% probability. For Taiwan, there would be a seizing of control of semiconductor facilities. So semiconductor companies such as TSM, companies like AMD, NVIDIA, Qualcomm, major components of the SOX index, major components of the QQQ index, all of that would be severely impacted. Now let's understand what kind of economic consequences there would be from a more granular level. And we can look at this from the perspective of the Russia-Ukraine conflict. Some consequences that emerged were sky-high oil prices, higher wheat prices, higher food prices, higher fertilizer prices, material costs going up for semiconductor manufacturing. So in other words, inflation across the board entrenched, and that would be a major issue for both economies. And we know that Russia's largest export to the world is crude oil. And the reason this is valuable is that Russia is weaponizing gas against the EU. The EU, Europe, and Germany really depends on Russia's gas imports. And Russia is weaponizing gas right now because of the sanctions that have been issued on them. And this is one of the reasons that Ray Dalio is short Europe, because of this macro thesis. Now, what about Ukraine? How has Ukraine been impacted, and how are they impacting global trade? Well, Ukraine, they export major food components like seed oils, corn, wheat. They also export major semiconductor materials such as zinc. And Ukraine's export of grain may not be fully cleared, even though a lot of media headlines are discussing this due to ongoing turmoil. And this might lift wheat prices and grain prices in the future. So just because wheat prices have fallen from their highs in that May-June timeframe, we can see that the trend in the last several weeks have been consolidation for the wheat markets. And if there is a serious escalation again to prevent Ukraine from exporting grain, then wheat prices could be on the rise again. Now let's understand China and Taiwan's top exports, because that would help you understand how that's going to impact the current economic landscape. Well, China exports electrical machinery, machinery that includes computers, furniture, plastics, vehicles, everything up until organic chemicals. And these are major components that US companies use in their own manufacturing. And Taiwan's exports are very similar to China's as well. On top of this, Taiwan is the hub for semiconductors. 92% of the world's advanced semiconductor manufacturing happens in Taiwan. And Taiwan's semiconductor manufacturing company, TSM, has a market share of just over 52% of the global semiconductor foundry market. I'm going to explain what foundry means in just a moment. And if there is escalation over Taiwan, semiconductor chips would not be able to get out of Taiwan. And given how the chips industry is a major component of the NASDAQ, this would impact US stock markets in a big way as well. Now, a China offensive on Taiwan would make TSM potentially not operable. There's a lot of discussion among US academics and military leaders that if China does attack Taiwan, that Taiwan would have to self-destruct its TSM assets, and that would make the company not operable. Now let's talk about the collateral damage, and that's SEC delisting. And I know a lot of my friends on my channel follow Chinese internet stocks like Alibaba, Tencent. This is a major coverage point for me as well. I have positions in Alibaba, Tencent, and KWeb, and this is going to be a victim of a US-China escalation. And the way I view this is if there is delisting, all of our shares from the US market will eventually get transferred into the Hong Kong market. And so what I've been doing lately is opening up accounts on Moomoo, opening up accounts on Interactive Brokers. We can see here that I've opened up an account on Moomoo, and all future transactions on Alibaba, KWeb, Tencent, I'm going to be doing that on the Hong Kong listed exchange. I don't want to deal with the hassle of what would happen if there is a US ADR delisting event. So both Moomoo and Interactive Brokers are really good for this purpose. Interactive Brokers happens to have really great margin rates. Now we can see from this chart that Taiwan has one of the greatest representations among the foundry market. Taiwan is represented in yellow here. And if there is a war over Taiwan, we can expect there to be significant disruption in the semi-foundry production. And why is this important? A foundry is commonly called a fab, and it's also known as a semiconductor fabrication plant. And it's a factory where devices such as integrated circuits are manufactured. And these integrated circuits are used everywhere. Computers, mobile phones, smartphones, cars, airplanes, amplifiers, everything. And that means a China-Taiwan escalation would likely devastate the semiconductors industry, and the NASDAQ would be heavily impacted. And given that technology is 25 to 28% of the S&P 500, the S&P 500 would not be spared from a large-scale conflict. The largest component in the S&P 500 and the NASDAQ has significant reliance on China's supply chain. And once again, a reminder is that this company is Apple. And 90% of Apple's products are made by contract manufacturers in China. So this is something that you want to understand because Apple is represented in all three major indexes, the Dow, the S&P 500, the NASDAQ, all major mutual funds, all major growth funds. So if there is a major conflict over Taiwan, Apple might have significant ramifications. Now I want to talk about what we've been doing inside our community, share with you some exclusive research. My core view going into August, so this was discussed on August 1st, I'm going to share with you the headline report. And it's this. We discussed the possibility of entering the 4,200 region. We discussed this on August 1st. And as the S&P 500 grinds to this 4,200 region and beyond, I am personally reducing my exposure in my short to intermediate term holdings. I'm leaving my long-term positions unchanged. And I believe that most investors should too. There's no reason to really change long-term allocations unless you are near retirement. And as we approach that 4,250 to 4,450 level, I'm going to be significantly more aggressive in reducing my long positions. I've also shared my rationale behind my thinking process inside my community. and I share macro risks that the market is most likely going to face in the foreseeable future, and also upside catalysts. So for some major macro risks that we discussed, I talked about how that as the index grinds higher, the potential of misinterpreting the July FOMC's conference and therefore the Fed pivot, I rank that risk as exceptionally high. And I personally do not believe a Fed pivot is going to happen. Inflation is still at 8.5%. And while it fell from the previous month, there are components inside inflation, such as shelter and rent, that have been stubbornly high. And in fact, those components, which is the biggest allocation of CPI, actually rose from the prior month. So I'm not convinced that there is going to be a Fed pivot, and this miscalculation by investors could be tragic. It could lead people into a massive bull trap. So this is why I'm not excited about these levels whatsoever. I participated in this upside, my community has too, but I think the time for prudence, I think the time for cautiousness is definitely here. Now, there is a reason to be optimistic about the markets, and I like to provide a balanced view. We can see here there are some upside catalysts I've discussed, and one of them is the midterm elections. And I believe that it is likely the Biden administration will do everything in their power to convince the public that the economy is strong. In other words, rewiring what the definition of a recession is, rewiring what the definition of a bear market is. Investor positioning also happens to be very strong for the bulls. And the reason I believe this is there's a lot of cash sitting on the sidelines. And there were a lot of people who shorted the market when the S&P 500 was at 3,800. Of course, that's tragic for bears. This actually presents a lot of dry powder and a lot of strong positioning for the markets to continue their advance. But at S&P 500, 4,200, I believe a lot of that has played out. So I urge my friends listening to be very careful here on out. One of the reasons I'm also cautious is that the bond markets are sending a very mixed signal about the economy. At the beginning of this year, my friends inside know that the yield curve had an upward sloping trajectory. And by that May FOMC, June FOMC date, the yield curve had somewhat inverted. Today, we have a double humped yield curve, as we can see. And that means the bond market, which is substantially larger than the equity market, is very confused on where the US economy is going next. So if the bond market hasn't figured out the trajectory of the US economy, I don't think that we should 100% trust the equity market. So just be careful. Now, going into August, we assessed the fact that US semiconductor companies like AMD, Nvidia, they're particularly vulnerable to a US-China military escalation. A lot of these companies derive a lot of their revenues from China. And because the technical setup, the valuation setup, and the fundamental setup was not necessarily attractive anymore after the July rally, I shared an opinion inside our community that risk reduction was appropriate for semiconductors. And that opinion played out very well after Nvidia stock tumbled when they issued a revenue warning. Now, of course, Nvidia stock can rebound and diverge from company performance, but I don't invest like that. I want to make sure that my friends inside do not overpay for growth, because that would be a serious mistake. And I make decisions based on fundamentals. I also discussed that out of the FANG stocks, Meta had the best valuation among the group. And relative to other companies, since I published this report, Meta has had the most upside. So we have a to-do list, like I like to share at the end of a lot of my videos recently. Make a list of high quality companies that can fight stagflation. If you want to stay strongly positioned in the market and you want to have a lot of equity exposure because you personally believe the Fed has pivoted, at the very least, trade some of those speculative names down to the high quality names that can fight stagflation. That's the least you can do for a market that has risen nearly 15% on the S&P 500 and 20% for the NASDAQ. Also make sure that you're not mistaking a rising stock market for a weak economy, because eventually one reality will win. And the reality that I see around me, the reality that a lot of my friends see, is that there is no strong economy currently. And I do believe that eventually one reality will win. Form your plan ahead of time so that when the market gets to certain levels, you're not relying on emotion. You have an objective plan that you will follow through on. And when you go to take your girlfriend out to eat, split the bill, because you never know what the Fed might do next, okay? So with that said, guys, much love as always. I'll keep you updated with my emails, my Twitter, and my Instagram below. So make sure to follow me on all my channels in my description below. If you like this video, leave a like, subscribe, turn on the bell. And with that said, I will see you guys in my next video.